I want to start with something that might be uncomfortable to hear. The investing strategy you are currently using was probably built on advice that is 5, 10, maybe 20 years old. Not because you made a mistake, because that is how investing knowledge gets passed down. From advisors trained in a previous era, from books written before AI existed, from frameworks designed for a market that operated at human speed. And for most of investing history, that was fine. The market moved at human speed because humans were doing all the analysis, all the decision-making, and all the execution. That is no longer true. And the gap between investors who have updated their approach for 2026 and those who haven't is widening at a rate that should genuinely concern anyone who cares about their financial future. This video is about closing that gap, not by abandoning everything you know, but by upgrading it. Welcome to AI Wealth Pulse. If you are new here, this channel exists for one reason: to help you understand and use the intersection of artificial intelligence and wealth building before it becomes mainstream knowledge. Because by the time something is mainstream, the early advantage is gone. Today's video is one I have been building toward for a while, because the shift I am going to describe is not a trend. It is not a prediction. It is a structural change to how markets operate that is already in effect and already separating investors into two distinct groups. Group 1, investors who updated their mental model and their methods when AI changed the game. Group 2, investors who are still playing the old game, well, professionally, intelligently, but in a market that has fundamentally moved on. By the end of this video, you will understand exactly what changed, exactly what it means for your portfolio, and exactly what your first move should be. Let's start at the beginning. Part 1, the old game and why it worked. I want to be clear about something before I say anything critical about traditional investing. The old way worked. For decades, it worked extraordinarily well. Buy quality companies, hold them long term, diversify across sectors, rebalance periodically, let compounding do its work over time. That framework made millions of ordinary people wealthy. It is built on real principles: the power of compound growth, the futility of market timing, the wisdom of patience. None of that changes. What changed is the environment in which those principles operate. Think of it this way. Imagine you are an excellent chess player. You have studied the game for years. You understand openings, middle games, end games. You have developed genuine skill. And then someone introduces a new rule. One player gets to see the entire board 5 moves ahead, while you are still playing move by move. Your skill has not declined. The game has changed. That is precisely what happened to investing when AI entered the equation. The old game was built on 3 assumptions that no longer fully hold. Assumption 1, all market participants have roughly equal access to information. AI-powered investors now process thousands of data points, earnings transcripts, satellite imagery, supply chain signals, sentiment velocity, before a retail investor has finished reading a single article. Assumption 2, the market is slow, enough that careful human analysis can find mispriced assets before they correct. AI systems identify and act on pricing inefficiencies in milliseconds. Many of the opportunities that took weeks to develop and capture in 2015. Assumption 3, emotional discipline is the primary edge. The investor who stays calm wins. Still true, but no longer sufficient. Emotional discipline was a massive edge when most competitors were humans subject to the same cognitive biases. Today, your emotional competitor is an AI that has no emotions at all. The old game rewarded patience, diversification, and discipline. The new game rewards all of those things and adds a 4th requirement: systematic intelligence. Part 2, the 3 things AI actually changed. When people say AI changed investing, they usually mean one of 2 things. Either they mean AI trading bots that execute at superhuman speed, which is real but largely inaccessible to individual investors, or they mean using ChatGPT to research stocks, which is useful but barely scratches the surface. What actually changed is deeper than both of those. There are 3 specific shifts that matter, and understanding all 3 is what separates an informed 2026 investor from one still operating on 2019 assumptions. Shift 1. The information processing gap became structural. In 2019, a retail investor who did serious research, who read 10Ks, listened to earnings calls, tracked industry reports, could meaningfully compete with institutional analysis. In 2026, that same diligent investor is reading documents that AI systems processed and acted on before they were even fully downloaded. This is not about speed of trading. It is about depth of analysis. AI does not just read faster. It reads more completely, catching linguistic patterns across 5 years of transcripts, flagging anomalies in accounting language, mapping supply chain signals from 3 layers of adjacent companies. The information processing gap between AI-augmented investors and non-augmented investors is now structural. It cannot be closed by working harder. It can only be closed by using the same category of tool. The good news: those tools are now available to individuals. The bad news: most individuals do not know that yet. Shift 2. Pattern recognition at a scale humans cannot match. Markets are pattern systems. Humans are decent pattern recognizers, but only within the range of patterns we have personally experienced or studied. AI recognizes patterns across data sets that no human could process in a lifetime. It can identify that a specific combination of signals, a certain type of language shift in management guidance, combined with a specific inventory pattern, combined with a particular sentiment velocity curve, has preceded significant price movements in similar companies 17 times in the past decade. No human analyst sees that pattern, not because they are not smart enough, but because the data set required to find it is too large for human processing. This pattern recognition capability is now being applied in real time to every public market in the world every day, and the investors without access to it are effectively trading blind, not completely blind, but with a meaningful fraction of the available information missing from their analysis. Shift 3. Portfolio risk management became dynamic. Traditional portfolio management is periodic. You rebalance quarterly. You review allocations annually. You adjust when something dramatic enough happens to justify the attention. AI-powered risk management is continuous. It monitors correlations between positions in real time. It detects when assets that were previously uncorrelated begin moving together, often a warning signal before volatility spikes. It adjusts position sizing, dynamically based on changing risk conditions rather than waiting for a scheduled review. The difference between periodic and continuous risk management might seem academic in calm markets. In volatile markets, which 2026 has provided in abundance, it is the difference between a portfolio that weathers a storm and one that takes damage. It did not need to take 3 shifts: information processing, pattern recognition, dynamic risk management. All 3 now accessible to individual investors. All 3 ignored by the majority of retail investors still running 2019 playbooks. I want to stop here for a second, because I know what some of you are thinking. This sounds overwhelming. I am not a data scientist. I did not get into investing to manage AI systems. I just want to grow my money intelligently. That is a completely reasonable response, and I want to address it directly. Nothing I have described requires you to become a technologist. What it requires is a mindset update, a willingness to add one layer of systematic intelligence to the approach you already have. You do not replace your investing instincts with AI. You augment them. The best version of this is an investor who brings human judgment, long-term thinking, and genuine understanding of businesses, combined with AI-powered information processing, pattern recognition, and risk monitoring. That combination is genuinely formidable, and it is now available to anyone willing to build it. Part 3. The new investing playbook for 2026. The new playbook is not a revolution of your existing approach. It is an upgrade. 4 specific upgrades, each one addressing one of the gaps the old approach leaves open in 2026. Upgrade 1. Add an information layer. Before making any significant investment decision, run the relevant public documents through an AI analysis framework. Earnings call transcripts, SEC filings, industry reports, analyst commentary, not to replace your reading, but to surface what your reading might miss. Ask the AI to identify linguistic shifts over time, flag anomalies in financial language. Compare this quarter's guidance tone to previous quarters. This single habit closes a meaningful portion of the information processing gap between you and institutional investors. Cost: a few hours of setup and a low monthly tool subscription. Payoff: analysis quality that would have required a research team 5 years ago. Upgrade 2. Build a signal dashboard. Stop making investment decisions based on news you happen to read. Build a systematic signal monitoring system, even a simple one, that tracks the specific indicators most relevant to the companies and sectors you invest in. Supply chain reports for the industries you follow. Sentiment velocity for the tickers on your watch list. Upgrade 2. Build a signal dashboard. Stop making investment decisions based on news you happen to read. Build a systematic signal monitoring system, even a simple one, that tracks the specific indicators most relevant to the companies and sectors you invest in. Supply chain reports for the industries you follow. Sentiment velocity for the tickers on your watch list. Macro indicators that historically precede the sector. Rotations relevant to your portfolio. You do not need to monitor everything. You need to monitor the right things, consistently and systematically. AI makes building and maintaining that dashboard possible for a single person in a way that simply was not feasible before. Upgrade 3. Implement continuous risk monitoring. You add at least one layer of ongoing portfolio correlation monitoring, not a quarterly review. A system that flags when the correlation structure of your holdings begins to shift. When assets you assumed were diversifying each other start moving together. This is the upgrade most individual investors skip, and the one that matters most when markets get volatile. A single afternoon of setup. Continuous protection. Upgrade 4. Separate emotional decisions from systematic ones. This is the upgrade that requires the least technology and the most discipline. Build a rule before making any portfolio change driven by a news event, a gut feeling, or a market move. Run it through your AI analysis framework first, not to outsource the decision, to pressure test it. The AI does not get scared when markets drop. It does not get greedy when momentum builds. Using it as a check on your own emotional responses before they become expensive decisions is one of the highest value uses of these tools for individual investors. 4 upgrades. None of them require a technical background. All of them are implementable this week. That is the new playbook. I want to leave you with the framing that has most changed. How I think about all of this. We talk about AI investing as if it is a new thing you add to your financial life. But what it actually is, at its core, is the removal of the single most expensive element in every investor's portfolio, the gap between what you know and what you act on. Every investor has experienced this. You know you should not panic sell. You do it anyway. You know you should not chase momentum. You do it anyway. You know you should hold through short-term volatility. The volatility hits, and you do not. The gap between knowledge and behavior is where most investment returns go to die. AI does not eliminate that gap by being smarter than you. It eliminates it by being more consistent than you can be. And consistency, applied to a sound investment framework, over time, is the only thing that has ever reliably built wealth. Not genius, not timing, not luck. Consistency. AI is the most powerful consistency tool individual investors have ever had access to. And in 2026, for the first time, it is genuinely accessible to everyone. Let me bring this together. The old way of investing is not wrong. It is incomplete for a market that has fundamentally changed. 3 things changed. information processing speed and depth, pattern recognition at scale, and the shift from periodic to continuous risk management. 4 upgrades close the gap: an information layer, a signal dashboard, continuous risk monitoring, and a systematic check on emotional decisions. None of this requires you to become a technologist. It requires you to make one decision: that your investing approach deserves the same upgrade that every other serious professional skill has received from AI. Your first move this week: pick one of the 4 upgrades and implement it. Not all 4. 1. Subscribe to AI Wealth Pulse. Drop a comment below. I will see you in the next one.